Hello friends, welcome to the session. So this is the third lesson of the public finance, and in this third lesson we will focus upon the capital and the revenue budget. So lesson 3, capital and the revenue budget. Let us see what will be the coverage. We will see what are the components of the budget. We will see the revenue receipts, which include the tax revenue and the non-tax revenue. We will see capital receipts. We will see plan and non-plan expenditure. We will also discuss about revenue expenditure, capital expenditure. So we will discuss the meaning of each of these items, what is covered in the revenue item, what is covered in the capital item. All those things we will discuss in this session, right? So first of all, let us see the constitutional provision. What does constitution says about the components of the budget? So the constitution says that AFS means annual financial statement, that is the budget, has to distinguish expenditure on revenue account from other expenditure. So this is the simple statement which is given by the annual financial statement. So we will have to distinguish between the revenue account from the other expenditure. This is a simple line written in the Union Constitution, right? Now let us understand what is the practical dimension of this provision of the Constitution, right? So the budget can be divided into capital budget and revenue budget. Revenue budget means which contains the routine and recurring items. Capital budget means which includes the items which impact assets and liabilities of the government. Let me give you an example. Suppose, let us take the example of Mr. X, and Mr. X is a student, right? So सबसे पहले हम एक प्रैक्टिकल लाइफ का एग्जाम्पल लेके चलेंगे एक स्टूडेंट का, और इस एग्जाम्पल की मदद से हम लोग यूनियन गवर्नमेंट के बजट को भी समझेंगे कि रेवेन्यू बजट और कैपिटल बजट में क्या डिफरेंस होता है, ठीक है? तो मिस्टर एक्स है जो कि एक स्टूडेंट है. मिस्टर एक्स अपना बजट बनाता है. बजट के अंदर सबसे पहले वो देखता है कि मुझे पैसा कहां से आएगा. व्हाट आर द sources from where I will receive the money. In the second category, he lists down what are the items of expenditure. So where will that money go? तो पैसा कहां से आएगा और पैसा कहां पे जाएगा, ये एक स्टूडेंट का बजट है, ठीक है? Now student gets some monthly pocket money from parents, suppose 15,000 rupees per month. This is the monthly pocket money. On the expenditure side, he has to bear the regular expenses. For example, rent, food, and so on. So these regular expenses, they account for 12,000 rupees, right? During this month only, he has to manage two more expenditure. One expenditure is for the tuition, and he also wants to buy one laptop, right? So suppose the expenditure on tuition is 5,000 rupees and the cost of laptop is 20,000 rupees. So in totality he has 15,000 rupees in his pocket, but the person has to spend 20 plus 5 plus 12, 37,000, right? The person has to spend 37,000. That means there is a difference of 37,000 minus 15,000, 22,000 rupees. So there is a difference of 22,000 rupees. That means these 22,000 rupees have to be arranged by Mr. X from some sources. So Mr. X goes to his friend Mr. Y and says that please give me some money on loan. मुझे कुछ लोन, कुछ समय के लिए, मुझे 1-2 महीने के लिए लोन दे दो और मैं अपने पेरेंट्स से लेकर के आपको नेक्स्ट मंथ में पैसे दे दूंगा. So this is a loan. This loan, suppose he gets the loan of 7,000 rupees from his friend. So his friend is also a student, so the friend also don't have much of the money, so he gets only 7,000 rupees from his friend. Now out of 22,000 he gets 7,000. That means still there is a shortage of 15,000 rupees. For these 15,000 rupees, what he does, he has some, suppose scooter, right? So he has some old scooter which he got during his schooling time when he was in the 12th class from his father. But now because he want to buy the laptop and he want to expand on the civil service preparation, and he don't have the money, therefore he is ready to spend he is ready to sell the scooter. So he sells the scooter, and this sale is suppose 15,000 rupees, right? So this way he is able to arrange 37,000 rupees. In fact, let me change this example. Suppose he is able to get 20,000 rupees from the sale of scooter. So now he has how much? He has 42,000 rupees in his pocket. He has 42,000 rupees in his pocket. Right? So he need to spend 37,000 rupees, but he has 42,000 rupees in his pocket. So he thinks that because he is having 5,000 rupees extra, so he will repay back to Mr. Y. So he repays back to Mr. Y rupees 5,000 rupees. So this side also there is 42,000 rupees, right? So he has received 42,000 rupees and he has expended this 42,000 rupees. Now let us see from the point of view of revenue and capital. So monthly expenditure which he is getting from his father, this is the revenue receipt. So this is recurring in nature. Recurring means this comes every month, repeatedly. Recurring means repeatedly and regularly. And Mr. X has no obligation to return this money. This money will come and he can use the way he want to use. There is no foundation where this money can be used and where this money cannot be used. So this is the revenue receipt. This is the revenue receipt. The loan which he got from his friends, this is the capital receipt. Why this is the capital receipt? Because this has created a liability on the part of Mr. X. Liability means he has an obligation to repay back this amount to his friend. So when there is any liability creation, that means this is a capital receipt. So if there is increase in the liability, that means it is a capital receipt. Then sales of the scooter, that means asset has been reduced. This is also capital receipt. This is also capital receipt. Right? So revenue receipt, capital receipt and capital receipt. Now let us see from the point of view of the government. So in case of government, what are the revenue receipts? The regular incomes. Regular incomes are taxes, interest payments, the profit share from the public sector enterprises. Then there are many user charges which are levied by the government. So all those are the revenue receipts. What are the capital receipts? So the borrowings which are made by the borrowings which are made by the government. The borrowings can be in the form of issue of bond, or maybe from World Bank, maybe from some other country like Japan. So all those items are capital receipt. Sale of asset. If the government is selling some asset, for example, the government is selling its shares in the public enterprises. So that sale of the shares in the public enterprises is part of the capital receipt. So disinvestment is a capital receipt. So I hope this receipt portion is clear to you. I hope this receipt portion is clear to you. Now let us understand. So this is the receipt portion. We have discussed this receipt portion till now. Now let us come back to the expenditure part. A regular expenditure which Mr. X is making is revenue expenditure. So this is the expenditure which is incurred on day-to-day activities. This is revenue expenditure. Right? This is recurring, regular, and this is for day-to-day functioning of Mr. X. This is the revenue expenditure. Tuition. Tuition is also revenue expenditure. Even though tuition may not be a regular expenditure, even though it might not be required to be paid repeatedly, but it is not creating any asset, or it is not reducing any liability. Right? Purchase of laptop. Purchase of laptop means the asset has been created. So if asset is created, this is called capital expenditure. If any liability is reduced, for example, repayment made to the Mr. Y, this is also capital expenditure. Right? So similarly, in case of the government, if we link this example to the government, all the regular expenses of the government, which include salaries, which include interest payment, which include subsidies to the general people, all those are revenue expenditure. Increase in asset, that means the expenditure on road building, hospital building, school building, all those are capital expenditure because they are creating asset. There is increase in the asset. Liability reduction means when government is repaying some loan. So maybe government has taken some loan from the general public or foreign government or any other source. When this loan is received, that is capital receipt, and when it is repaid, this becomes capital expenditure. So this is the most simplified version of understanding revenue expenditure, capital expenditure, revenue receipt and capital receipt. Now let us come back to the capital budget and the revenue budget. So I told you that there are two components of the budget, the capital budget and the revenue budget. Right? Capital budget and the revenue budget. So in the capital budget and liability, so we include those items which we see more detail. It has two items. One is capital receipts, another is capital expenditure. So we have capital receipts and we have capital expenditure, right? This capital receipt means either the asset is being sold, so asset is reducing, for example disinvestment receipt, or we are receiving amount which needs to be repaid. We are creating some liability, we are creating some obligation. For example, we are taking loan from general public, foreign government, multilateral organization, etc. So either the asset is decreasing or liability is increasing. In case of capital expenditure, the reverse happens. That means either the asset will increase, right? So expenditure will be made and road will be built, building will be built, power plant will be built, sanitation infrastructure will be built, or there will be repayment of the loan or repayment of the already created obligation. So there is reduction in the liability. So this thing you have to keep in mind very clearly, that capital items impact the asset and liabilities. If there is no impact upon the assets and liabilities, it is not a capital item, right? If it is not impacting asset and liability, it is not a capital item. All other items, and most of those items are routine and recurring in nature, they are part of the revenue budget. Again, this revenue budget can be classified into two items: revenue receipts and revenue expenditure. So all those receipts which do not impact asset or liability, they are revenue receipt. For example, tax revenue. So tax revenue does not impact any asset or liability because the government is not supposed to repay it back. So there is no liability creation. Any share of profit received from any public enterprise, that is also part of the revenue receipt. What is the meaning of revenue expenditure? Revenue expenditure means expenditure on day-to-day functioning. For example, the salaries paid to the government officers, the interest payment made to the made on the loan, right? So that is part of the revenue expenditure. So with this foundation, with this foundation, now we will discuss what are the components of capital receipt, what are the components of capital expenditure, what are the components of revenue receipt, and what are the components of the revenue expenditure. So what will be the sequence of our discussion? In our discussion, first we will discuss about revenue receipt, then we will discuss about capital receipt. After that we will discuss about capital expenditure, and finally we will discuss about revenue expenditure. Sorry, the third item is revenue expenditure and the fourth item is capital expenditure. So in this session we will discuss all these items in detail. I hope this discussion that we have done so far is more than sufficient for creating the foundation for this lecture, right? So once the foundation is done, let us move ahead. So coming back to the statement given by the annual financial statement, the Constitution of India. As per the Constitution of India, annual financial statement has to distinguish expenditure on revenue account from the other expenditure. Therefore, the union budget is classified into revenue budget, which covers the items which are of recurring or routine nature, and capital budget covers those items which are resulting into acquisition and disposal of capital assets and liability. Let's see over here in the general budget we have receipts and we have expenditure. The receipts are further classified into revenue receipt, capital receipt. Expenditure is further classified into revenue expenditure and capital expenditure. Revenue budget, which contains revenue receipts and revenue expenditure. This revenue receipt, so those receipts which are regular and recurring in nature and the government receives them in its normal course of activities. It has two essential conditions. Number one, it does not create any liability for the government and it does not cause any decrease in the asset. We have already discussed this point. This revenue receipt, this can further be classified into two categories. One is tax revenue, another is non-tax revenue. So all the amounts which are received from the tax, that is tax revenue, and all other receipts are non-tax revenue. What is the meaning of tax? Tax is a compulsory levy, L-E-V-Y. It's a compulsory levy over the citizens of a country. Compulsory means they don't have any discretion not to pay. They don't have any choice. The government has imposed the tax and it is compulsory. So it's a compulsory payment from the citizen to the government. This is the first feature. The second feature is that there is no direct benefit provided by the government to the taxpayer. So there is no reciprocal obligation from the side of government that if you are paying me 1 lakh rupees of income tax, I will pay you this thing. No, there is no direct benefit. But definitely the government is receiving the tax amount and is utilizing for the common benefit of all the people, right? So it is a compulsory payment and there is no direct obligation on the part of government to return something to a particular taxpayer. So you can see over here sources of revenue receipt. We have tax revenue. Tax revenue refers to sum total of receipts from the taxes and the other duties imposed by the government. Friends, for the taxation part, I will have a separate session. What is the meaning of tax, direct tax, indirect tax, and how the tax is calculated, and then there are many more things which include GST also. So we will have a complete detailed session on the taxation after this session is complete. So do not worry, we will discuss everything in detail, right? Here I am giving you just a starting point for the taxation. So this is the tax revenue, and all the revenue which is not part of the tax revenue, that is non-tax revenue. So here you can see different items which fall in the tax revenue, different items which fall in the non-tax revenue, and the non-tax revenue has one more component, that is other non-tax revenue, right? Now all these items we will discuss in detail now onwards. So tax revenue means, what is tax? Tax is a compulsory, there is no choice to the citizen, compulsory payment made by the people and companies of the government without reference to any direct benefit in return. There are two aspects of taxes. Number one, tax is a compulsory payment, no one can refuse to pay, and tax receipts are spent by the government for the common benefit of all the citizens. Now these are the important items of the tax revenue. The first item is excise duty. Excise duty is levied on the manufacturing, right? So if we talk about this pen, this digital pen, so for this digital pen some raw material is arranged like plastic and other components, and those plastic and all those items, they are converted into this pen. So this is called the process of manufacturing. So conversion of input into the output through some process, that is called manufacturing. So on this manufacturing, the tax which is levied is called excise duty. So duties of excise on certain goods manufactured or produced in India, like petroleum, crude, high-speed diesel, aviation turbine fuel, tobacco and its product, etc. Right? So as of now we are in the GST era. GST means goods and services tax. So now most of the item on manufacturing, it is not the excise duty, rather it is the GST which is levied. But there are certain items on which GST is not levied. So on those items, excise duty is levied on the manufacturing. The key point to note is that this is levied on the manufacturing. Please note down this point. This is very, very crucial, that this is levied on the manufacturing. GST, it is a tax on the supply of goods and services. So it is a tax on the supply. Supply can include sales, it can include supply from the factory to the wholesaler, from wholesaler to the retailer, from retailer to the customer. So supply is a very wider term. Supply is a very wider term. And this is the tax which is levied on the goods as well as services. Please notice, this excise duty is levied only on goods. This is not levied on taxes, not levied on services. So manufacturing of goods, this is levied on supply of goods and services. So here the point of taxation is supply. Custom duty. Customs duty is on the import and export of item. So when any commodity crosses the border, either in the form of import or in the form of export, the tax which is levied on that transaction is called customs duty. So here the word duty, in the common parlance, it is the tax only. Taxes of UTs. So UTs means Union Territory. So in India, UTs except Delhi and Puducherry are under the direct administration of the center. So all the taxes which are collected by the UTs without legislature, right? So these UTs are UTs without legislature. Can you give the example? Example include Andaman Nicobar, Dadar and Nagar Haveli, Chandigarh. So these are the UTs without legislature. So in case of UTs without legislature, all the taxes which are collected from there, they are included over here. Then we have other taxes, the tax income from other taxes like wealth tax, income tax. Income tax is levied on the income of the people, and this can be further classified into corporate tax. Corporate tax means tax on the income of the companies. So it is levied on the company. And personal income tax, the tax which is levied on the personal income of the individuals. So if the tax is levied on income of you and me, it is personal income tax. If it is levied on the profit of the company, then this is called corporate tax. In the non-tax revenue, we have three prominent item. Non-tax revenue includes interest on the investment made by the government. So it is the interest income from the loan given by the government. So this loan might have been given to the state government. So central government gives lot of loan to the state governments, or it might be given to the different government agencies. For example, to the public sector undertakings, to various departments like railways, right? So all the loans which have been given by the government, the interest received on this loan, this is also revenue receipt, but this is non-tax revenue. Dividend. So let us understand the meaning of dividend and profit. So there are two more items in the non-tax revenue. One is dividend, another is, right? So dividend is just basically a division of profit. So with this we complete revenue receipt portion. Now let us come to the capital receipt. Right? So when central government buys the shares of any company, it becomes the owner of that company to that extent. So let us suppose example NTPC Limited. NTPC Limited is a power generation company in India. Central government has 51% share in the NTPC Limited. During the current year, suppose NTPC earns 1000 rupees. So out of this 1000 rupees, 51% of 1000, that is rupees 510, will belong to the government. So government is the owner of 51%. Therefore out of 1000 rupees, rupees 510 belong to the central government. So this rupees 510, when it is received by the union government, this is called dividend. This is called dividend, right? So dividend means the share of profit which has been received from the government or other companies where the government has less than 100% shareholding. Profit means the profit received from those companies or those enterprises where the government has 100% ownership. So for example, railways. So if railway earns some profit, and because railway is under the 100% ownership of the government only, in fact railway is one of the departmental undertaking of the government, and then there are many other companies, especially the defense companies. So when the company is completely under the ownership of the government, 100% ownership is with the government, all the profit belong to the government at that point of time, this is called profit. So when the profit is divided and one of the division of the profit is received by the government, this is called dividend. So dividend is also part of the profit only. It is also part of the profit only, and this is profit from those companies where ownership is 100%, right? So both interest and both dividend and profit are also part of the both dividend and profit as part of the non-tax revenue. And then there are other fees and receipts which are collected from different services. So let us see all those items over here. So these include all the fees and other services which are provided by the government and the user charges which are collected for those services. So other non-tax revenue items. What are these items? First item is grant in aid contribution. So grant in aid contribution means any kind of gift or donation or assistance which is received by the government from any foreign government, right? So many times various countries, they support Indian government for different purposes. It might be for women empowerment, for health sector, or maybe for infrastructure development. When that amount is received, that is called grant in aid contribution, and this is part of the revenue receipt. Now here I want to tell you one point. When any assistance is received from the foreign government in the form of loan, then it is part of the capital receipt. So if there is any assistance in the form of loan, it does not become part of the revenue receipt. Why? Because if we are receiving any assistance in the form of loan, it creates liability. We are under obligation to repay the amount to the assistance provider in the future. So for example, India receives 0% interest loan from the Japanese agency, Overseas Development Agency. So in the Japan, there is an agency, Overseas Development Agency, which provides assistance to the developing countries like India, and this assistance is in the form of 0% interest loan. So there will be no interest levied, and the loan will be provided for a very long period of time, maybe 25 years, 50 years, 100 years. So those kind of receipts are part of the capital receipt. They are not the revenue receipt. Please understand this point very, very carefully. In the prelims examination, there are very high chances that examiner can ask this question. Next is other general services. So central government provides various general services. For example, receipts from the public service commissions. So when students of the UPSC preparation, they fill up the form, they are supposed to deposit some fees. The fees can be as low as 50 rupees, 100 rupees. So that fees is part of the receipt over here, or maybe some other organization. Social services. So if the government charges something from the public for the education, so for example, government has various universities, so all the fees which is collected by those central government universities, that comes over here. Sports fees, art and culture, so various exhibitions are conducted by the government agencies. The visitors fees collected on those exhibitions is part of the social services fees. Health, information and publicity, etc. Fiscal services. Fiscal means money related. So you must be knowing that rupee 1 coin, rupee 1 note is issued by the central government, right? So profit from circulation of coins represents the difference between the face value of coins and the cost charged, right? So suppose the cost of issue of currency is rupees 50. Rupees 50 is the cost or expenditure, and the value of currency issued is 1000 rupees. So 950 is the currency coinage minting fees. Other fiscal services, there are other various fiscal services which are also part of the other non-tax revenue. Non-tax receipt of UTs. So UTs are also collecting a lot of receipt in the form of receipt from the administrative services, sale of timber and forest produce, receipt from Chandigarh transport undertaking, receipt from shipping, tourism and power, and so on, right? So you don't need to remember each one of these items, just understand the concept. So here we can see we have covered all these items. So we have covered excise duty, custom duty, taxes of UT, income tax. We have covered interest, dividend, profit. We have covered grants in aid contribution, other general services, social services, fiscal services, and non-tax revenue of UT. So capital receipt, very simple. All those receipts which impact the asset and liability, and mostly they are non-recurring and non-routine, but majorly they have to satisfy any one of the following two conditions. One is the receipt must create a liability for the government, or it must cause a decrease in the asset, right? So we have already discussed this point in the starting of the session. Here you can see the difference between the revenue receipt and the capital receipt. Once again, revenue receipt means they do not have any impact on the liability and asset, and capital asset means they either create liability or reduce any asset of the government. Nature, they are regular and recurring, and they are irregular and non-recurring. Future obligation, there is no future obligation to return, but in case of capital receipt, in certain cases like borrowings, there is an obligation to return back the money. Example, it can include tax revenue, non-tax revenue. Here it can include borrowing, disinvestment, etc. So now let us see various components of the capital receipts. So in the capital receipt, there are primarily two kinds of receipts. First is the debt receipts, and second is non-debt receipts, right? So debt receipt means the loan or any amount which is to be paid back, that is debt receipt. This debt receipt has further two categories. One is borrowings and another is other than borrowings, right? So borrowing means the money which has been raised by the government. That means the government goes to the another person or agency and demands the money from them, right? So borrowing means the government has raised the loan from any other agency or general public, right? Other than borrowing means that someone else has put its money with the government. So although government did not go to the other agency or other country, but that country agency or person has kept the money with the government, because government provides safety, there is a trust on the government. So I hope you remember the word like provident fund, right? So provident fund is basically coming under this category, because the provident fund was not raised by the government as a loan, but individuals have kept with the government so that they can withdraw at any point of time, right? So it is an obligation on the part of government. It is a obligation on the part of government, but it is not the borrowing, right? So other than borrowing and borrowing. Now these borrowings can further be classified into two categories. One is external borrowing and other is internal borrowing. External means the amount which has been raised from outside the country, right? This external can further be classified into bilateral and multilateral. Bilateral means it has been raised from some other country. Multilateral means it has been raised from a group of countries or maybe from some international organization. So the money which is raised from the World Bank or IMF, that becomes part of the multilateral loan. If it is raised from a particular country, for example USA, Japan, then it becomes part of the bilateral loan. In case of internal, we will see in detail in the next slide onwards. This also we will see in detail. Non-debt receipts, it includes first disinvestment. So disinvestment is basically the sale of shares held in the public enterprises by the government. Secondly, repayment of loan, right? So when government gives the loan to state government, when central government gives the loan to the state government, it is part of the capital expenditure. But when that money is recovered back from the state government, then it becomes part of the non-debt capital receipt. So these are the items which become part of the capital receipt. Now we are going to discuss these internal borrowings, right? Internal borrowings. So, and when we discuss the internal borrowings, before that let me discuss a briefly about the bonds. What is the meaning of bond? So bond is a basically instrument. It's a simple paper on which the government says that if you give me 100 rupees today, after 1 year or after 2 years, I will give you this amount back along with some interest. So this is a loan raising instrument. And let us see the process. So Government of India, it wants to raise rupees 100 as a loan. So it issues the instrument to the general public. This is the bond. And the face value of this bond is 100 rupees. Face value means on the bond it has been written that the value of this bond is 100 rupees. That is the face value. The value written on the bond itself. That is the face value. Now Government of India issues this bond to Mr. A, and Mr. A is ready to pay rupees 100 only. So this becomes the issue price. So just keep in mind that this issue price can be less than 100 also, maybe more than 100 also, depending upon the credibility of the government and the affordability of the Mr. A, right? So depending upon the market situation, this issue price can be equal to face value or less than or more than face value. So if it is equal to face value, we call it issue at par. If the issue price is less than the face value, then we call it issue at discount. These are the oil bonds. If the issue price is more than the face value, then we call it issue at a premium, right? So 3 different conditions are possible, but for our example we are considering that face value is equal to issue price, that means at par, right? Now Mr. A will give back rupees 100 as the loan, right? Now whenever there is any loan, on any loan some interest is also given. So Government of India says that I will give you the interest at the rate of 5% on this 100 rupees. So this is also called as coupon rate, right? Coupon rate. So let us suppose the duration of this bond is 1 year, right? Or let us suppose 2 years, right? Duration of this bond is 2 years. That means after 2 years, Mr. A can sell back to the Government of India, and Government of India will have to give back the money to Mr. A, right? Now Government of India in this bond has written that we will give you maturity value of 105 rupees of each bond. That means after 2 years, Mr. A will get 105 for each bond apart from the interest, right? So every year Mr. A will get interest at the rate of 5% on the 100 rupees, that is rupees 5. So for 2 years Mr. A will get 5 rupees each as interest, as well as the government will also give this 100 rupees, 105 rupees as the maturity value for the bond, right? So Mr. A's total income becomes 105 plus 5 plus 5, 120 minus 100, right? So 105 is the maturity value, 5 rupees interest for the first year, 5 rupees interest for the second year, that becomes 120. So total 120 is received Mr. A, and Mr. A paid 100 rupees, that means 20 rupees is the income of Mr. A, right? And this is the cost of the bond for the government, right? So through this discussion, I have basically discussed the concept of face value. I have basically discussed the concept of the face value, you can see, and the concept of coupon rate, the concept of issue price, the concept of maturity value, the concept of duration of the bond. So this is the normal or general understanding about the bond. We will discuss more about it when we discuss the chapter of money markets. Now there is one more kind of bond which is issued by the government, which is treasury bill. So this is issued only and only by the government. So general bond, which we discussed in the previous slide, that can be issued by any agency, even the private companies, but this treasury bill is issued only and only by the government. And there is some feature of this treasury bill, that this treasury bill is issued at a discount always. So issued at a discount. So suppose the face value is 100 rupees, the issue price will always be less than 100 rupees, and for our example, let us say 94 rupees, right? And the maturity value is always equal to face value. That means the maturity value is 100 rupees, right? So if someone from the general public buys this treasury bill from the government, he or she has to pay 94 rupees, and he or she will receive back 100 rupees. So in totality there will be income of 6 rupees, right? So this is how this treasury bill is working. And very interestingly, there is no coupon rate. There is no coupon rate in case of treasury bill. This is very, very crucial. The question has already been asked on this topic in the year 2017. So there is no coupon rate on any treasury bill, right? So there are some important features. The issue is always a discount. The maturity value is at face value. There is no coupon rate. This is how the treasury bill works. And also one more important aspect, the treasury bill, duration of the treasury bill is maximum 1 year, right? So it cannot be more than 1 year. The duration of the treasury bill cannot be more than 1 year. Now we will understand each and every concept. First is the market loans. Market loans means the loans which are raised by the government by issue of bonds with a maturity of 12 months or more. So this is not a treasury bill, because here the maturity is more than 1 year, right? They are generally interest bearing. That means they have the coupon rate. Treasury bills issued to RBI and the banks, so they differ in maturity, like 14 days treasury bill, 91 days treasury bill, 182 days treasury bill, and 364 days treasury bill. So maturity can be any duration, but less than 1 year. I already told you, less than 1 year. And they are non-interest bearing. So there is no coupon interest. There is no coupon rate. I already told you. And issued at a discount. Issued at a discount rate, right? So the face value is 100 and the issue price is 94 rupees. So this is how the treasury bill works. So first was the market loan, second is the treasury bill, third other internal debt, the debt raised to meet budget apart from the above two methods. So if any other kind of bond is issued, then that is also considered over here. Next item is non-negotiable, non-interest bearing securities issued to international financial institution. So technically it is basically part of the external borrowing, right? So it is not part of the internal borrowing. This item is part of the external borrowing. So non-negotiable means once anyone buys these securities, the buyer cannot sell the security before the maturity, right? So in the example that we discussed before this discussion, the example of bond, the duration of the bond was 2 years. In the duration of 2 years, if Mr. A considers appropriate, then Mr. A can sell the bond to anyone else to receive the money, right? But here this is not negotiable. That means this cannot be sold. The general bonds can be sold. That means they are negotiable. They are tradable in the market. But this kind of securities are non-negotiable, means there is no sale or trade possible before the maturity date. Non-interest bearing, there will be no interest securities issued to the international financial institution. So the buyers are always the international financial institution, right? securities issued to international financial institutions like World Bank, Asian Development Bank, they are non-negotiable, which means they cannot be sold, very very crucial, to others by security holders and can be redeemed only from the issuing authority. So if the government of India has issued, then only and only government of India can buy back. There is no other institution which can buy back these securities. Next is funded securities. Funded securities. So funded securities basically means when treasury bill is converted into the market loans. That means suppose the maturity of treasury bill is 364 days, that is less than 1 year, but the government thinks that we need this money for a longer period of time, suppose 3 years, right? So government says that okay, we want to extend the validity of this treasury bill to 3 years. So once this is converted into the market loans, this becomes funded security. So short-term treasury bills converted as market loan to defer repayment are funded securities. Other special securities issued to the RBI, right? So bonds issued by the government to raise fund outside its annual borrowing program, which are subscribed by the RBI. Example, oil bonds. So there are many situations where government needs to raise the money to meet a particular requirement. For example, many times the government want to give subsidy to the oil marketing companies, right? It want to give the fuel subsidy. So in these cases, government will issue these bonds to the RBI, and RBI will pay the money to government, and government will pay money to the oil marketing companies, right? So it is ways and means advance. Ways and means advance is basically a short-term advance which is given by the central bank, that is RBI, to the central government, right? So RBI or central bank is the banker of the government. We already know about this. Many times the government balance with the RBI comes to negative. That means it comes below 0 rupees. So in such cases, RBI makes the payment on behalf of the government by giving the advance to the government. So this advance is called ways and means advance. So RBI acts as a banker to the government. We already know about this. We already discussed about this in the banking sector. It receives and pays money on behalf of the government. If the balance goes negative, RBI lends short-term interest-bearing advance. The key point to note is that it is interest-bearing. So the central government will pay interest to the RBI, to the government. This is called a ways and means advance. So ways and means advance. Advance means a short-term loan. Advance means a short-term loan. Special floating and other loans. Floating loans basically mean where the rate of interest is not fixed. The rate of interest keep changing depending upon a particular factor, right? So this is the floating loan. So these are loans to raise money and their interest is subject to revision periodically. So interest rate is revised, right? So if we say fixed interest rate, that means the interest rate which was fixed at the time of giving the loan. And floating interest rate means the interest rate is revised as per the agreement between the loan giver and the loan receiver. Then we have securities against small savings. Securities against small savings. So there are various small saving schemes of the government. For example, Kisan Vikas Patra, etc. and so on and so forth. So against these small securities, the government issues, against these small savings, the government issues various securities. So these securities are also part of the internal borrowing, and out of this fund, 20% of amount is invested in the central government securities. Compensation bond. So various kind of bonds are issued by the government to compensate for various things to the individuals or the institutions. So bonds issued by the government to the affected persons by its policy decision. So many a times you might have heard about the land acquisition policy. So when government builds some infrastructure project, the government might require the land of the different individuals. So at that time the compensation bond can be given to different individuals, right? Multilateral loan. Multilateral loan is part of the external borrowing, right? So this multilateral loan and bilateral loan, they are part of the external borrowings. External borrowings means the borrowings from outside India. So multilateral loan means loans received from multilateral agencies like International Monetary Fund, World Bank, etc. Bilateral loan, the loans raised from the foreign governments directly, right? So foreign government, it is basically bilateral means from one country to another country. So when India is taking the loan from USA or Japan, right? So that particular loan is called bilateral loan. Now this small saving scheme, this is part of the other than borrowing receipts, right? So in the capital receipts we discussed that capital receipt can be of two categories. One is debt receipt, another is non-debt receipt. Inside the debt receipt there can be two kind of receipts. One is the borrowing. Borrowing can be internal and external. So till now we have discussed internal and external borrowing both. Another category inside the debt receipt is the receipt other than borrowing, but they are part of the debt receipt only. So those are the receipt which have been kept with the government by the general public, but actually they are not the borrowing. The government is not going to the general public to raise that money, right? So they have been kept by the public. So these are the small saving schemes. So the small saving schemes currently in force are, for example, post office saving account. So for example, postal department has the saving account of the individual. When individual deposit this money in the post office saving account, this money is kept in the small saving scheme, because this money has to be returned back ultimately to the account holder. Therefore this is a debt receipt. This is an obligation which needs to be returned, right? This is an obligation which needs to be returned. Post office time deposit. So what is the meaning of time deposit? Time deposit means whose duration is long and which are generally not withdrawn by the account holder before the expiry of the maturity, right? So there are two kind of deposit. One is demand deposit, means the deposit which can be withdrawn by the account holder on the demand. That means at any point of time the account holder can go to the post office and withdraw the money. Time deposit means a kind of fixed deposit. The person has deposited the money for at least certain period. The period can be 6 months, 1 year, 2 years, and the withdrawal can be done only after that period unless and until there is some emergency. Post office recurring deposit. Recurring means which happens again and again. So every month the person is depositing 10,000 rupees. So this is a recurring deposit. So all the post office accounts, they are the small saving scheme. Why they are part of the small saving scheme? Because they are not the post office is not a bank. So in the recent time the Post of India Post Payment Bank has been opened, but Post Payment Bank is different from the General Post Office. The General Post Office is basically representing the government of India. That is not a bank, right? We are talking about that. Post Office monthly income account, senior citizen saving scheme, national saving certificate. So these are the saving certificates, saving instrument where general public deposits the money and public knows that because this money is lying with the government, it is completely safe. So for the purpose of safety of the money, this amount is deposited by the government deposited by the public in the different kind of saving instrument. National saving certificate and public provident fund. Even the provident fund amount is also part of the small saving scheme. What is the meaning of provident fund? Provident fund is basically the monthly payment which is deducted from the employee's salary and deposited in a account. At the time of resignation or at the time of retirement, this amount accumulates and this given back to the individual, right? And also not only the individual or employee is depositing the money, but an equal amount is also deposited by the employer. So this is provident fund. So provident fund, it includes general provident fund and state provident fund, right? Other accounts, deposits of non-government provident funds. So the private sector government funds basically, right? So these are also part of the other than borrowing, and this is also other than borrowing. Reserve funds, these are funds created by departments to iron out excessive variations, undue fluctuations in revenues by using it as a buffer. So this is a kind of emergency amount which is kept by the government, and this is called reserve fund. Here you can see in the first part of the slide, this picture I have taken from the Union Budget 2021, which was introduced in the month of February 2020. So here you can see different items of receipt. In these different items you can see borrowing and other liabilities. So these are the borrowing and other liabilities. Borrowing, it can have internal borrowing, external borrowing. Other liabilities we have seen small saving account, provident fund, etc. Then we have this GST receipt. We have this corporation tax, right? So they are basically capital receipt, and these are the tax revenue items. Non-debt capital receipt we have yet to discuss. They basically include the receipts like disinvestment, the receipts like repayment receipts, right? Union excise duty, income tax, customs, right? So these are various items. In the second half, expenditure items have been given. Since we have not discussed the concept of expenditure, therefore we will not discuss as of now. Now coming to the revenue expenditure, right? In fact, before revenue expenditure, I should discuss this non-debt capital receipt, because this part has been missed in the slide. Non-debt capital receipt. So in the non-debt capital receipt, first there is disinvestment. Disinvestment means the government is having shareholding in many government companies. When this shareholding is sold to some other person, the government receives the money in lieu of that. So this is called disinvestment. Disinvestment. So investment is basically sold by the government. So these kind of receipts are basically called disinvestment. We will discuss this concept of disinvestment separately in a different session. So don't worry, you will get everything. Number 2, repayment receipts. So central government gives various kind of loan to the government agencies, to the state government, etc. When this loan is given to them, at that point of time, this is capital expenditure. But when this amount is received back, this is capital receipt. So this is basically nothing but the repayment of loan received from the state government or other agencies to which the central government gave the loan earlier, right? Now coming to the expenditure part. So till now we have covered the receipt part completely. Now we will discuss about the expenditure part. In the expenditure, there are two kinds of expenditure: the revenue expenditure and the capital expenditure. What is the meaning of revenue expenditure? Revenue expenditure means the expenditure which does not impact the asset and liability, and which is normally incurred for day-to-day functioning, right? So revenue expenditure which does not result in creation of asset for the government. This includes the expenditure incurred for the normal running, for example, salaries, for example, interest payment, pension, etc. Expenses incurred to provide various services, making interest payment on debt, grants in aid, meeting subsidies, etc. Generally, all the grants given to the state government or UTs and other parties are also treated as revenue expenditure, even though some of the grants may be used for the creation of capital assets. So this point is very simple. Suppose central government gives various grants to the state governments, right? Now this grant, it can be used by the, this is the grant basically to the state government. So this grant can be used by the state government for day-to-day functioning, or it can be used for any asset creation. So utilization by the state government does not define the nature of this grant. If this is a grant is basically kind of donation, it's a kind of gift, it's a kind of assistance, right? It is not a loan, right? So if this grant is given, this will always be classified as the revenue expenditure, right? This will always be classified as a revenue expenditure. It does not matter whether state government is utilizing it for revenue purposes or it is utilizing for the capital purposes. It does not matter. What matters is if it is grant, it is always part of the revenue expenditure. Please make this point very clear, because many times the question has been asked from this portion. Again, there is one more point, loan. If central government gives any kind of loan, whether the loan is given for day-to-day usage or for any capital creation, this loan is always classified as the capital expenditure. Please be careful. This loan will always be classified as the capital expenditure. So grant always revenue, loan always capital. Please keep in mind this thing, right? At this point of time, I also want to clarify one more thing. Suppose central government gives the loan to state government, and this is basically loan, and the value of loan is 1000 rupees, right? This loan is given for 5 years, and there is some interest, suppose interest of 10%. So after 5 years, state government will return back to the central government rupees 1000 plus 10% annual interest, that is rupees 1050. When this loan is given by central government to the state government, it is loan and it is capital expenditure. It is capital expenditure, right? When this amount is returned back by the state government to the central government, this amount of loan, this is the principal, basically this is the principal amount. Principal amount means this is the repayment of the loan. This is the capital receipt of the government, central government. This is the capital receipt, and this interest income of the central government is part of the revenue receipt. This is part of the revenue receipt. Please be careful. The receipt of repayment of loan by the central government is capital receipt, and receipt of the interest income on the loan which have been given by the central government, those are revenue receipt. Please be careful. This is very, very important for the examination point of view. Next, let us suppose IMF gives some loan to the government of India. This loan is given, suppose rupees 100, and the rate of interest is 5%, and the duration is 1 year. So after 1 year, the government needs to give back this money to the IMF. So government will give rupees 100 of the principal amount and rupees 5, that is the 5% of 100, rupees 5 of the interest. Now please tell me, this 100 rupees which is paid by the central government, is this a revenue expenditure or a capital expenditure? This is a capital expenditure. Although I have not yet discussed the capital expenditure, but in the starting we already did the foundational discussion with some examples. This is a capital expenditure because this is impacting the asset and liability. This interest payment by the central government, this is revenue expenditure, right? So interest payments are the revenue expenditure. Can I say in simple term, the repayments of the loans, whether they are receipt or expenditure, they are always capital in nature, and the interest transaction, whether we are receiving the interest or paying the interest, they are always revenue in nature. Please be careful, please understand this thing very carefully, please, so that you do not mistake in the you do not do any mistake in the examination hall. Generally in the prelims examination, this kind of concepts are very they become very important. So coming back, now you read these lines. Generally all grants given to state governments, UTs and other parties are also treated as the revenue expenditure. All the grants, all means all, even though some of the grants may be used for the creation of the capital asset. So you can see different items of the revenue expenditure. Interest payment, I just discussed, all the interest payment are part of the revenue expenditure. Expenditure on the defense and police, expenditure on the subsidy. So subsidy is a basically benefit given to any particular citizen for a specific purpose. Grants to the state and UTs, please be careful, this is a grant. Whenever you are reading, please see whether this is a grant or loan. If this is the loan, then this is capital item. If this is the grant, then it is the revenue item. Pensions and salaries of the government employees, economic services, other general services, social services, all this we will discuss in this session only. And expenditure on the UTs without legislature, right, that is also part of the revenue expenditure. And in the last, you can, this is not visible to you, grants to the foreign government. Grants to the foreign government. Grants to the foreign government are also part of the revenue expenditure. Now coming back, interest payment, so they are all item of the revenue expenditure. I am just discussing in detail. Interest payment, interest paid on borrowing and other liabilities, discount on treasury bill constitute this category, right? So whenever government is paying any interest on any kind of bond or any kind of other obligation, that is part of the revenue expenditure. If it is a repayment of loan, then this is part of the capital expenditure. Please be careful. Discount on treasury bills. What is discount on treasury bill? I already told you. If the issue price is 94 rupees and maturity value is 100 rupees, that means the government is basically bearing the cost of 6 rupees. So this is basically the discount only, right? Defense and police expenditure towards law and order. All the expenditure on defense and police which is done for day-to-day functioning, that is part of the revenue expenditure. Subsidies on the public distribution fertilizer. So primarily there are three kind of subsidies. Subsidy on the food, fertilizer and fuel. So highest amount of subsidy is given to the food sector in the form of public distribution system. Second highest subsidy is given to the fertilizer and third highest to the fuels. This is the ranking as per the latest economic survey. Latest economic survey and budget. Grants to the states and UTs, grants given by the center to the states and UTs come under here, right? So again, grant means grant, it does not mean loan. Salaries and pensions of the central government department and those paid out of the consolidated fund as charged expenditure. We have already discussed the concept of CF and concept of charged expenditure. Economic services, non-capital expenditure towards agriculture, industry, power, transport, communication, right? So non-capital means the expenditure which is not creating any asset or reducing any liability, right? So if expenditure is done on the agriculture sector, industry, power, so example of agriculture is basically, for example, the fertilizer subsidy. Fertilizer subsidy is example of the economic services over here, right? Power subsidy, in many places the power subsidy is also given. In case of industry, various kind of interest, the interest subsidies are given, right? Other general services, so non-capital expenditure towards organs of states. Organs means the department of states, tax collection department, external affairs, right? So even the tax collection expenses are also part of the other general services. Social services, non-capital expenditure towards education, health, broadcasting. So all the expenditure for day-to-day functioning of the education, health and other sectors, that is part of the social services. Postal deficit. So postal department is part of the government. and many times it is quite possible that postal department is making the loss. When it is in loss, then government has to bear this loss. So this becomes part of the revenue expenditure. So postal department is unable to meet its expenditure out of its own revenue. So whenever expenditure of the postal department is more than the receipts or revenue of the postal department, then this is called the postal deficit. Expenditure on UT, expenditure towards administration and other expenditure on the union territories without legislature. Please be careful, this is for the without legislature. Grant to the foreign governments, grants given to foreign government towards their developmental expenditure and given during disaster and natural calamity. So India is a very generous country. It gives various kind of grants to the small countries in case of disasters. For example, in case of tsunami, it gave various loans. So all those grants are part of the revenue expenditure only. Coming to the capital expenditure, so all the expenditure which either create the asset or reduce the liability, right? So loans and advances granted by the central government to the state government, government, companies and other parties, right? So all the loans which are given, they are part of the capital expenditure. Expenditure incurred on acquisition of assets like land, machinery, investment, right? So all the expenditure on infrastructure creation. So if the government is expanding on the road building, that is part of the capital expenditure. Third item is the repayment of loan by the government. Loans taken by the central government. So central government might have taken some loan from the public or maybe from the general international institutions. So when the central government repays this amount, then this is part of the capital expenditure, right? Plan and non-plan expenditure. So plan expenditure is that expenditure which has been done as per the schemes formulated in the 5-year plan. So this plan and non-plan differentiation happened in 2017. As of today, there is no such kind of differentiation. So 12th 5-year plan under the planning commission existed till 2017, and this plan non-plan differentiation also existed till that point only. So plan expenditure means the expenditure done as planned under the 5-year plans, and all the other expenditure are part of the non-plan expenditure. Why we have abolished this? We have abolished this because this gives a wrong perception to the general public that plan expenditure is developmental and non-plan is non-developmental. However, in reality, the plan expenditure may or may not be developmental and non-plan may also be developmental, right? So to abolish this misconception, we have actually abolished this plan and non-plan. Now there is nothing called plan and non-plan differentiation. Now we only see whether the expenditure is revenue or it is capital. If it is impacting the asset and liability, this is the capital. If it is not impacting the asset and liability, this for the day-to-day functioning, that is the revenue. This is the very, very simple point. So it covered only that part of the total expenditure that was meant to finance schemes specifically started under a plan or which is spilled over from the previous year as per the plan. Non-plan expenditure, it comprised maintenance and running expenses on the completed schemes. So salaries, interest, so whatever day-to-day expenses you think, they are the non-plan expenditure. This is a figure I have taken from the budget, and in this budget you can see the different items of receipt and payment, basically not receipt, payment. This is the expenditure part. So you can see pension expenditure, defense expenditure, subsidies, agriculture, commerce and industry and other areas, right? You don't need to remember all that. Subsidies, this is very crucial. Just keep in mind, food subsidies highest, fertilizer subsidies second highest, and petroleum subsidies lowest. And again, this is as per the latest budget document. These are the key numbers. We have already discussed revenue and capital receipt concept. So revenue and capital means total receipt and total expenditure. Now we will discuss about these concepts of deficit, right? So in the next session we will discuss all about the deficit concepts.